Welcome to the Pro Ticker Deep Dive. Today we're doing a really critical deep dive. We're calling this one The Hard Landing That Never Came.
A very fitting title.
Right. Our mission here is to really get into the source material and figure out why those, near unanimous predictions of a recession in mid-2024 just failed.
And what that failure tells us about the U.S. economy now, the structure of it.
Exactly. Because if you think back just 18 months ago, the consensus was totally overwhelming.
Oh, it was a sure thing.
Wall Street strategists, everyone, they were certain the Fed's rate hikes had to break something. We were all just bracing for that hard landing.
And the result was, well, it was a historic surprise. The economy, it didn't just swerve a crash. It didn't even land softly.
It just kept flying.
It just kept flying higher. I mean, look at the numbers. The S&P 500 put up a stunning 27% gain in 2024.
An incredible year.
And it's already tacked on another 17% this year, and we're only in November of 2025. That puts us in the fourth straight year of double-digit returns.
Which, after that kind of monetary tightening, that shouldn't happen, according to the old models.
It suggests the models are deeply flawed. To really get it, you have to remember what the Fed was trying to do.
Yeah.
They had to crush inflation from, what, a 40-year high?
Right, a 40-year high. And do it without completely cratering the job market. It's the definition of a tightrope walk.
And they didn't exactly use a light touch.
No, it was more like a sledgehammer. They pushed that benchmark rate up 5.25 percentage points.
In just 15 months, it peaked at that 5.25 to 5.50% range by July 2023. Highly restrictive.
Historically, that's a recession. Guaranteed.
It is. If you look at any major tightening cycle since the 70s, one just follows the other. And the market was convinced. Mid-2024, recession odds were basically a coin flip.
And all the signals were there, the classic one.
All of them.
The inverted yield curve, for instance.
Which had been almost infallible.
And credit was tightening up. Leading indicators were, rolling over. Everything pointed to disaster.
But instead of a downturn, the economy just sort of decelerated. It found a more sustainable pace.
And it held on to full employment while inflation cooled off.
Exactly as the Fed wanted. The big takeaway is that the U.S. economy was just far more resilient than anyone thought. And that resilience, it comes from some really profound structural changes.
Okay, so that brings us to the core of this deep dive. We've pinpointed three, let's call them structural pillars, that let the economy just completely ignore the history books. So what's the first one?
The first pillar is the dramatic shift in wealth concentration. This is a factor that economic models, they just don't really weigh properly.
Wealth concentration. So we're talking about the gap between the rich and everyone else.
In a way, yes. Over the past couple of decades, wealth, and more importantly, disposable income, has become heavily concentrated with large corporations and, say, the top 10% of households.
And why does that matter so much when rates go up?
Well, because these groups are just less sensitive to borrowing costs. Think about it. If rates go from 0 to 5%, that's a huge deal for a family trying to buy a car on credit.
Of course.
But the spending power of the wealthiest, 10%, it isn't tied to short-term loans. It's in assets, in equity. So their spending kept the whole engine running even as the Fed was hitting the brakes.
So monetary policy just doesn't hit everyone equally anymore.
Not at all.
Okay, that makes a lot of sense.
Yeah.
The second pillar is one that forecasters, I think, completely missed. It was demographic.
Absolutely. The boost from immigration in 2023 and 2024 was huge.
How huge?
Our sources estimate it added about 1% to real GDP growth, right when the labor market was supposed to be cracking.
Wow. So it filled the gap.
It did more than that. When you increase the supply of workers, it keeps wages from overheating, which helps fight inflation, but it does it without the mass layoffs that you see in a typical recession. It was the perfect offset.
And the third pillar is about how the economy itself has changed, right? We're not a big industrial economy anymore.
Exactly. It's about service sector adaptability. Back in the 70s, if rates went up, a factory would just stop building, cut production, and lay off hundreds of workers.
A huge, immediate shock to the system.
A huge shock. But now, think about a modern software company. In a slowdown, they can maintain profit by, say, freezing hiring or optimizing things internally. The adjustments are faster, less dramatic for the whole economy. We're just more flexible now.
Okay, so the underlying structure was way stronger than expected. But how did the market react while everyone was still screaming about a recession?
Well, you look at corporate earnings. That's the most important signal, and they held up remarkably well.
That told the real story.
It told you the hard landing narrative was dead long before the analysts admitted it. If companies are making money, the market will climb.
And we know who's making the most money. The Magnificent Seven.
Oh, yeah. Apple, Amazon, Microsoft, Alphabet, Meta, Nvidia, and Tesla. They drove the bulk of the gains, mostly on that huge wave of AI excitement.
Their global reach and profit margins basically made them bulletproof to a domestic slowdown.
That's a good way to put it. They're just structured to handle high rates better than almost anyone else.
Wait, hold on. That sounds like a massive concentration risk, doesn't it? If just 7 stocks are pulling the whole market up, isn't that incredibly fragile?
That is the perfect skeptical question, and it leads directly to valuation.
Right.
Because while the rally was narrow in 2024, the market was expanding its price-to-earnings ratio, the PE ratio, pretty significantly.
So investors were willing to pay more for every dollar of future earnings.
A lot more. The S&P 500's PE went from about 18 at the start of 2024 to 21 or 22 by the end of the year.
And that wasn't just about earnings. That was a vote of confidence.
It was the market screaming that the hard landing was off the table. And crucially, by mid-2025, that rally started to broaden.
So it wasn't just tech anymore.
Right. We saw financials, industrials, even smaller companies start to join in. That suggested the confidence was finally spreading.
Let's touch on the employment picture because I think that confused a lot of people. The unemployment rate went up from 3.8 to 4.4%. That looks like a classic red flag.
It does. And this is where you really have to dig into the data. Because the actual number of people with jobs in the U.S., it went up during that time.
Wait, so how does unemployment go up if more people are working?
It's simple math, really. The labor force just expanded faster than jobs were being created.
So more people started looking for work.
Exactly. Driven by those demographic inflows we talked about and maybe people unretiring. The denominator, the total labor force, just grew faster than the numerator. This is a sign of a healthy, growing supply side. It's not the collapsing demand you see in a recession.
And at the end of the day, the Fed got what it wanted. Core inflation dropped from its peak of 5.6% all the way down to about 2.8% by late 2024.
They walked the tightrope, no catastrophic labor collapse.
So now we pivot. We're in this, what do they call it? The no landing, soft landing, the Goldilocks economy.
That's the narrative. The bullish case is that the Fed keeps cutting rates, maybe down to a neutral level of, say, 3.25% by mid-2026.
And with AI driving productivity.
The S&P 500 keeps growing. The aggressive targets are out there. Some are saying 7,000, maybe 7,100 by the end of 2025.
And in that world, who are the winners?
Well, large cap tech is still a favorite, of course. But with the rally broadening, financials look good. Cyclicals, too, like industrials and materials, as long as the consumer stays strong.
Okay, that's the beautiful blue sky scenario. But if 2024 taught us anything, it's humility. So we have to talk about the fault lines, the risks. Let's go through the 5 big threats that could fracture this whole thing. What's number 1?
I'd put the tariff wildcard right at the top. If new 2025 policies are aggressive, companies pass those costs on to consumers and boom.
Inflation is back.
Inflation reignites and the Fed stops cutting rates. The rally would grind to a halt.
And then there's the valuation issue we just talked about. We're trading at 22 times forward earnings.
Right.
That's pricey.
It's very pricey. It leaves you with zero margin for error. The market is expecting, 7 to 10% earnings growth if we only get 3 or 4%.
That multiple has to come down.
It will compress, and you'll see a significant correction, maybe 10, 15%, even without a recession.
Threat number 3. Those subtle cracks in the labor market. The unemployment trend is still up. Even the Fed is warning about downside risks.
Right, and consumer spending is 70% of the U.S. GDP. It's been resilient, but if businesses do finally start serious layoffs, those lower-income households, they will stop spending, and that could start a negative feedback loop.
Number 4 is geopolitical risk. Always there, but always a threat.
It's the flight to quality risk, a major conflict, a trade war escalation. Investors panic. They pull money out of stocks and into safe havens like treasuries. It's a sudden shock that has nothing to do with how well companies are actually doing.
And finally, in number 5, subtle credit deterioration.
This one's like a slow poison. It doesn't hurt Apple or Microsoft, but it crushes smaller, leveraged companies that need credit to grow. If credit gets too expensive, the rally could narrow again, leaving only the giants standing.
That's a sobering list.
Yeah.
Okay, let's look at the charts. Bring some objectivity here. What does the S&P 500 chart tell us right now?
Visually, it just confirms the rally's success. It's a clean, strong uptrend from the lows in August 2024, around 5,360 up to where we are now, near 6,750.
And the long-term trend is still solid.
Very. The 200-day moving average is rising steadily, that's the floor, and it's holding firm. The dominant trend is still bullish.
But are there any technical warning signs, any signals that we're overstretched?
Oh, definitely. There are some behavioral cues. For one, the volume on this rally has been modest. It suggests it was driven by concentrated money, not broad enthusiasm. And second, momentum indicators like the RSI.
Relative Strength Index.
Right. It's been consistently above 70 recently.
And for our listeners, an RSI above 70 usually means what?
It's the classic overbought signal. It means buyers push the price up too far too fast, and a pullback is probably due. The chant isn't saying the party's over, but it is screaming that the easy money has been made.
So if a pullback does start, what are the key levels to watch?
Upside resistance is at 6,750 to 6,800. A clean break there opens the door to that 7,000 target. On the downside, the key support level to hold is around 6,300 to 6,400.
Which is about a 5% pullback.
Exactly. But the real line in the sand, the signal that the entire bull market structure is at risk, would be a decisive break below that 200-day moving average.
Okay, so let's tie this all together. The big lesson here seems to be humility, right? Old models failed because the world changed.
That's the whole story. That structural resilience from wealth, demographics, the service economy, that's probably going to stick around. But the market has already priced that in.
So temper expectations.
Absolutely. Don't expect another 27% year. The consensus is for single-digit, maybe low-teen returns for 2025, and you have to be ready for more volatility, more sharp, sudden pullbacks.
Which means this becomes a stock picker's market. It's not just about passive indexing anymore. It's about finding quality names that can thrive in this Goldilocks world, while avoiding the companies that are vulnerable to those 5 threats.
And that really brings us to our final thought. The economy avoided the hard landing because of these new structural pillars that the old models just didn't see. The lesson is to always be asking why the economy might be resilient.
Instead of just focusing on why it should fail.
Exactly. The skies are clearer now than they were in 2024, for sure, but there is still plenty of turbulence ahead.
See you all in the next Pro Ticker Deep Dive.